Well, hello, everyone. Thank you for joining us today for our podcast, big podcast. Today is September 17th, and we just had a big Fed meeting this afternoon, and we're going to be covering that in details. So we have a pretty extensive agenda, primarily focusing on the Fed decision and what effect that is going to have on our markets. And then we're going to talk about what's the outlook for the stock market till the end of the year, maybe even next year. And then there's only a couple of months left for until year end, and we've had a big, beautiful tax bill that there is some planning opportunities that I will go over with you here in a little bit. And then I wanted to also give you an update on what areas of the markets we like, what changes we're making, and all those good things. So without any further ado, let's get right to it, because we've had a change this time from what the Fed had been forecasting. Before today's meeting, the forecast was to only have two interest rate cuts for this year. Well, today, based on surveys and things that Dryden is going to talk about, we had a 25 basis point cut, first cut this year. But for the first time, we're also forecasting two interest rate cuts, one in October and one in December. So Dryden, why is that? Why did that change? And what effect? Well, tell us first, why did that change?
Well, a couple of things. I mean, you have to remember we've been predicting a cut in September for quite a while. I mean, last year you had September, you had 50, and then you had 25, 25. And so this is probably the most clearly anticipated and forecasted rate cut in a long time around it. And they cut 25 basis points. There was some speculation that they would try to cut 50, and there really wasn't a reason to do that. There's been some speculation that we would do, 25 and another 25 in October, another 25 in December. There's this debate, right? Is it going to be 25 or 50? The point of the matter is the timing's right. We had a year, prior to this, we had a year at 550 and we dropped it to 450. Now we've had almost a year at 450. Now we're going to drop it to 425, then 4, then maybe down to 375. What really was going on here was a realization that, first of all, you had a lot of corrections in the data around the labor force. You had a lot of corrections around the data around unemployment. And you had a period of time where we were looking at unemployment and inflation equally. And I think the Fed has said, well, wait a minute, we're going to weight unemployment a little higher risk than inflation at this point. Inflation has seemed to stay relatively benign. This spike in inflation that everybody was predicting with the tariffs and stuff like that. The bad things about the tariffs that everybody was voicing just haven't occurred. Reality has basically came in and said, look, reality is a lot different than what everybody was going crazy about when they were thinking about the tariffs were going to be the end of the world. That hasn't happened. They have not spiked inflation. They have not tanked the economy. They've not done any of these things that back in April everybody was thinking about. So what you're seeing is a normal adjustment on the unemployment rate. Now, people freaked out a little bit because they said, oh my gosh, full employment or jobs fell below 100,000. Here's reality. The labor market, or the pool of available workers, has shrunk. The amount of jobs that we have to create every month to keep us at about a 4.5% unemployment rate has come down from about 186,000 jobs to about 89,000 jobs. And the reason why is you have a labor force, how many people age out, how many people retire, plus you don't have as much immigration as we had before. So before you had to, in order to keep everything at 4.5%, you had to have 186,000 jobs. Well, now you don't. It's gone down. So now you only need to maintain labor equilibrium about 86,000. So you had this big data correction that came in last quarter. And there's a lot of reasons why they did that. And now you're looking at how many jobs are we creating? Well, in the last couple of months, we have not been creating quite as many jobs as normal to keep us at equilibrium.
Why is that?
But well, basically there is a slowdown in the economy. This
Okay.
is the Fed got what it wanted.
Slow down.
They wanted it to slow down, and guess what? It did. Now, I've said this 1,000 times. We went from going 90 miles an hour to 50 miles an hour. That doesn't mean we're shrinking, and certainly does not mean we're headed for a recession. What it means is that we're moved into a sustainable growth pattern. And that's really important. If you look at final sales to domestic purchasers, if you look at most recent GDP growth, all of those numbers are looking pretty good going forward, and personal consumption expenditures are rebounding. So all the things we look at, health of the consumer, health of the economy, health of growth, all of those are actually looking better. You had a couple of months where it was getting ugly, and part of this was people were nervous. They were scared. They didn't really know what was going to happen with the tariffs. So you had employment cut back, you had purchasing cut back, you had all these things cut back for several months, and now they've realized that the boogeyman did not show up, right? And so everything's getting kind of back to normal. And so now the Fed is able to say, all right, we're going to have an insurance cut. We're going to go ahead and cut 25 basis points because we see equilibrium occurring. Right now, remember, I've been talking for months about we had more jobs than we had people looking. These things are now in equilibrium, which is about right, because now you don't have pressure on wages or inflationary cost push. What you really have is a labor force and a labor market that is coming into equilibrium. You have a fair amount of unemployment in college graduates, and that's quite frankly, that's an AI thing. If a company is looking, they say, hey, maybe we're going to try this AI thing. We'll see if AI can do what an entry-level employee could do. But all the other rest of the segments in terms of age of the economy seem to all be in balance. So what we've done is we've had an insurance cut to give some stimulus to the economy, to start the rate cutting cycle. And we've done it really a year after we did the last one. All of these things are positive. There is no reason for anybody to think we're running into a recession and that's why the Fed is cutting, or that we're doing anything. This is a general moment where the Fed is cutting in a growing economy to have insurance that they're able to continue this sustained. So we see things really being quite stimulative going forward. So yeah, the non-farm payroll additions, and that's coming back into balance. And I think we're going to find that that's why they did it. They had the room to do it. But I do want to explain to everybody the number of jobs that we need today to maintain an acceptable level of unemployment is much lower than it used to be. I said many times before, in months in the past, as long as we were over 100,000, everything was good. Well, now the labor force isn't growing as fast. So now as long as we're in the 70s or 80s, we're doing good. We're a little bit below that. Fed cuts the interest rates. We'll go back up.
So funny because I called Verizon the other day and it said, well, we are now using AI to help you. I thought that was very, very cool. They actually admitted that and they were able to help me. And I thought that was very cool. AI is going to affect unemployment. And it is a big deal, and we love investing in it. But beside that, the Fed talked quite a bit today about SEP, and it's not Sapphire. If you're familiar with that, SEP stands for Survey of Economic Projection.
The summary of
Economic projection, and it's a very important thing because that's the dot. So, Jonathan, explain to our audience here, what is SEP? Why does it matter?
Sure. When we look at, so it's the summary of economic projections. First of all, there's 18 members of the Fed. There's 12 on the open market committee. Those are the people that have votes. So you have this rotation. So all 18 people do their summary of economic projections. They're all putting in, here's what I think is going on, here's what I don't think is going on. They summarize these things and they use that as a baseline for their predictions for the future. So a couple of things happened between 25, so in the previous projections, they really thought that real GDP was going to grow like at 1.4, but now they find out that it's really looking at 1.6, so that's positive. So they think GDP growth is going to go up in 2025 and in 2026. You began to see that's real GDP, which you subtract out inflation, but now the nominal GDP, they think that that's going up as well, both in 25 and 22. You see the unemployment rate either flat or they think it may go down a little bit. And then they look at inflation going up in 25 flat, but going up a little bit in 26, but not dramatically. So this is why I said this is kind of an insurance cut. None of those numbers would portend a big, massive cut because they're actually all kind of look pretty decent as you look into 2026. So what they pretend is we now need to be in a position where there's been some changes. The economy is better than everybody thought it was going to be, right? And it's certainly bearing out that. But what we want to do is make sure that we move forward in this stable fashion. So it's kind of like they'd rather be maybe risk a little early than risk too late. So I think that's kind of where we are on this. But the projections have changed, and the projections, it's a little contradictory.
You
Because
said that today.
yeah, it is contradictory because in some places you look at these projections and you go, well, there's really no reason to cut. But I think that having waited as long as they have, we're 1 year into it, it's almost like you can easily get away with a quarter point cut, and be all right. And then we'll be, data dependent for the rest of the months. And we've got more data coming in.
All right. So, the market has a lot of good things going for it. We have potential deregulation in the financial service. We have the big, beautiful tax bill, which is going to be a huge stimulus. We have artificial intelligence, which is reducing companies' costs and increasing their profit. And now we have lower rates, forecasting a bit more than we thought they would be. So that should be a good effect for the market. So taking all those things into account, Dryden, what do you think we can expect from the market this year and maybe next?
Well, we're looking at a market this year. We really kind of are where we sort of expected to be, high single digit, low double digit market. We think we're going to get some things. You can always get these pullbacks. You can have these moments and stuff, but I think we're going to continue to see a market be positive throughout the rest of the year. We're going to end up the end of the year. We're probably up on the S&P 500, low double digits. But I think that the real story here, in the end, it's all about earnings. And I think that earnings have grown at 10 to 12%. If earnings are going to grow at 10 to 12%, then the market's going to grow at 10 to 12%. If you look at next year, you have earnings growing again at 10 or 12%. So the market's going to probably grow at 10 or 12%. When you're moving into a lower interest rate environment, sometimes you see multiple expansions, so it could be a little better than that. I think realistically, what you're seeing this year was, remember, we had a big reduction in interest rates last year. One full basis point, right? Like a 20% decrease in interest rates. Well, all of that for small caps and mid caps tend to show up in margin expansion. So as we move into this set of circumstances of lowering some interest rates, whether it's 1, 2, or 3 cuts, whether it's 25 basis points or 75 basis points, you're going to see a lot of that money show up in margin expansion in your small and mid cap companies, who tend to have different debt levels and things like that. So we think that piece of the market is going to look reasonably well going into next year. The rest of this year, these companies are probably going to continue to have increased margins. That means increased profits and earnings, against an economy that has a lot of stimulus coming at it. You have lowering interest rates. That's important. The other thing that is important, and you're going to talk about this in a little bit, is the tax policy is showing up Very positive. And then you take a look at some of the, you take a look at some of the big companies, Microsoft and Amazon and those guys, they've got billions of dollars of additional free cash flow that's going to come and hit their balance sheets just because of the changes in tax policy. So all of these things are stimulative moving forward, both at the corporate level and at the consumer level. So this is why we're kind of encouraged for the rest of this year and moving into next year.
And they've got huge reason to invest, right? Because they get huge tax deductions.
Exactly.
So not only are they going to get a big tax benefits, but they're going to invest back in the economy, invest back in people. They're going to invest back in equipment, which will then turn into more earnings and better economy, which is starting to show up.
This environment is probably one of the best ones that we've had for a long time for companies to deploy capital in areas that will increase labor productivity long term. So now they're able to make greater investments, fully depreciate those things, invest in the future, and get greater labor productivity so they can get more profit margin off of every labor input. And this is probably one of these best environments going forward into this year, moving into next year. And companies are experimenting. They're experimenting, like you mentioned, with Verizon, with AI and other things. How much can I get technology to do? Indeed, labor productivity is an all-time high, and it's only going to get higher. And I think that we're going to continue to see that, and that increases profits for companies.
I love it. Okay, so just a few things with regards to taxes. Just another stimulus that I wanted to talk about is that, this SALT deduction going up to 40,000 for people making basically less than 500,000 and it fizzes out at 600,000 is a big deal, especially here in California. It could potentially save, clients and you anywhere between 8 to 10,000. But all the planning and all the withholdings right now that people are making are not taking that into account. So come next April, we think there's going to be another stimulus because people will have more refunds coming in.
Refunds will probably be bigger than most people expect. And
exactly.
And what does an American consumer do when they get money?
Spend it.
They spend it.
Right. And so I want you to make sure that all of you are taking advantage of this. And one of the ways you do that is that if you you might, for the very first time now that we have a $40,000 SALT deduction, which is state and income taxes and property taxes, is if you are not quite at that 40, then you may want to prepay your property taxes. And normally, you have a payment in December, you have a payment in April, but you may want to take a look and see whether it makes sense to go ahead and pay both payments now so that you're maximizing that 40,000. Also, if you normally make estimated state tax payments and they usually are due on January 15th of next year, I would think you might want to pay it in December so that you can get enough state tax deduction so you can get that $40,000 write-off on your personal taxes. Also, charitable deductions. The new tax bill does allow a $2,000 above the line deduction. So even if you don't itemize and you're taking the standard deduction, you can, as a joint filer, you can send in $2,000 as a charitable contribution and get a full deduction in addition to your standard itemized deductions if you cannot itemize. And a single taxpayer, it's $1,000. And of course, if you're doing charitable deductions and you are going to be able to itemize now because of that SALT deduction, you may want to do as much as you normally want to, as much as possible before year end so that you're maximizing your deductions this year. So those are just simple things that you want to do to maximize your taxes this year. Also, make sure that you, if you have not done your RMD, this is RMD season, contact us and let's get that going. And we're doing a lot of tax planning for year end right now to make sure that if we have to do withholdings from your RMD, that we're doing the right amount and taking advantage again of the SALT deduction for you. So that's just some things that I wanted to make sure pass on to you with regards to taxes. Couple other things that we want to talk about is, Andrade, you touched up on this a little bit. What are some of the things that you're looking at as far as our portfolios right now that you're changing or modifying?
Well, I think we could still like, consumer discretionary. We still like consumer durables. Anything going to the consumer, we tend to like because they are good to spend. I mentioned before small caps. I think that we begin to see small and mid caps grow in this environment. They tend to, with the lowering of interest rates, it's going to help it margin expands. I think industrials are actually going to do well, and we still like defense. I think we look at global defense in that sense because the world is not going to spontaneously break out in kumbaya, and we're going to continue to have the European countries need to step up for their own defense. They're doing that. You have other things going on. So we like those parts of the sectors. We like technology. We still are in favor of chips on dips, as I've said many times. And I think that we're continuing to see this fundamental build out of the AI infrastructure. We're still in the early innings there, and we're beginning to see companies recognize the promise of artificial intelligence in terms of increasing labor productivity. So that's, as you mentioned, Verizon, and getting a virtual assistant to handle certain things for better customer experience. So all of those things go to say that it's a good diversified portfolio, but that we're leaning into growth now a little bit. We were kind of balanced through a lot of this period of time, value and growth. We're leaning a little more growthy because I think that's kind of where it's going to look better in 25, 26. We think most things are going to do well. I think that when you think of on the fixed income side of stuff, the changes that when we make, we've been very short on our duration and playing short term because it's where we're getting the highest relative yield. And I think what we're going to begin to do now as we're going deeper into a Fed tightening cycle is we'll begin to move from ultra short to a little further out, increase a little duration on the curve, not a lot, but I think begin to make some moves in the fixed income area
Fed
as we go
reducing
into
the
this.
cycle.
Yeah, and that's kind of what you do in a standard event.
So the one thing why we also is happening with the markets, money goes where it's treated best. And stock market has had basically the safety of CDs and savings and treasuries that were paying pretty good. Now they're going to start paying a lot less because today they've gone down a quarter. We potentially could be down another 0.5%, and then next year.
Yeah, as rates come down, the idea that now if you're going to get some return, you may have to lean into equities a little bit. So everyone keeps talking about this massive amounts of money still on the sidelines. And you're probably going to, particularly probably more so in 2026, begin to see that happen because if you have two more rate cuts, so you get, sometime in 2026, maybe you get a third one, you find yourselves where if you're going to get meaningful yield, you're going to have to reach into value and dividend paying stocks.
Right. And if you were getting 4% before, next year you may be getting 3%.
Yeah.
So if you are interested in locking in some higher rates while we still have them, certainly contact us. You could, there's some things that for some of the safe money, as opposed to saying more variable. On the other hand, if you're borrowing money, variable rates right now should be coming down. So that could be attractive on the short term. We do have securities line of credit that are available. And when rates are going up, we lock up the rates we have. When rates are going down, then we want to stay variable because they automatically go down as interest rates go down. So keep that in mind when you're thinking about your debt structure and your investment structure. If you want to lock in some safe money, this is the time to do it now. But at the end of the day, money goes where it's treated best. And if rates go down and you're not getting as much in the bank, we do think that will do well for the markets as well, beside earnings, beside good deregulation and good outlook. So we do have a podcast next in October because we do have a Fed meeting. So the Fed meets actually on October 29th, but our podcast will be on November 4th, which is election day. So, and it's a Tuesday, so it's different. So as you can see, we've been moving our podcast dates around because some people say, why do you always do it on Thursday? I always have this thing on Thursday and I can't never make it. And then, so today we're doing it on Wednesday. Next November, our next podcast will be on a Tuesday. So if, we're going to keep moving those dates around so that we allow many more people to watch us and listen to us on these podcasts. And also, there's always a replay. So Ruben does a really great job about doing the replay later on. Oh, Dryden also wanted me to have you talk about tariffs.
Yeah, I want to take a second here. We didn't get to cover this earlier. There's some talk about, oh my goodness, we have the tariffs, and the tariffs are create the world did not come to an end, yay, and it's creating a lot of revenue, yay. But now the Supreme Court is looking at these lawsuits that were promulgated at the time they thought the world was going to come to an end, and so now that they've worked themselves through, and what happens if we disqualify the tariffs that the president has used. Two things there. One, if they had to refund everything, that in and of itself would be stimulative. I don't think that comes into the case. I think what the facts of the matter are is the president used authorities, kind of maybe stretched them, maybe not. That's not I'm not a Supreme Court justice, but in the event that the Supreme Court invalidates the tariffs that the president used, the president has a lot of other authorities which allow him to do the same thing. It's more difficult. It takes a little longer. You have to kind of have hearings and investigations, and you have to do some things, better cooperation with Congress. But the end state would be very much like what we have today. And this is one of the practical things that everybody's going to have to look at. They could invalidate it, but then the next thing you know, they give them time to just have a different way of getting the same things done. So reality is the tariff regime is either as it is unscathed today in place, or as he manipulates it going forward, he's going to get his way. And so the point of the matter is now we're working in this environment where what we said before was that the big beautiful bill, the tax cuts in there, what was the pay for it? Well, the tariffs are increasing the revenue necessary to balance those things, so it becomes net stimulative. But for those who are worried about what happens if the Supreme Court invalidates all of this, the answer is there's sufficient legislation and rules and regulations does he go through that and use those, it becomes very, very hard to take these things off in the future.
Okay. Well, thank you so much for all the great information. Thank you all for joining us this afternoon. We look to speak to you in our meetings, and of course on November 4th. Please tune in at that time. Thank you and have a great evening.
Layla Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Dryden Pence is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. The financial professionals affiliated with PWM are registered representatives with, and securities and investment advisory services offered through LPL Financial, a registered investment advisor, member FINRA/SIPC. Pence Wealth Management PWM and LPL Financial are separate entities.